Before we start this video, I want to show you a trade we took during the recent Bitcoin drop using the Fibonacci confirmation strategy. Look at this. Bitcoin made a strong move down and broke a major support zone. That break showed a clear bearish trend. So we started looking for a short entry to ride the move down. Most traders wait for a simple break and retest. The price breaks support, comes back up, taps the zone, and they short. That works, but it's basic. We don't take trades based on one signal. That leads to weak setups. We want solid confluence. This is where the Fibonacci tool comes in. We pulled the fib from the start of the move down to the swing low. When we stretched it across, the setup became clear. The retest zone lined up with the 0.618 fib level. As price reached that area, we saw small candles showing the push-up was losing strength. Then we got a long wick and a strong bearish engulfing candle. All these signs lined up: a retest of a key resistance zone, a fib level match, and a clean candlestick pattern. That gave us the confidence to enter the short. The trade played out well, and we caught a 5R move. This is one of the ways we use the Fibonacci retracement tool, and that is exactly what you are going to learn in this video. Most beginner traders treat Fibonacci like it's some magic crystal ball that's going to tell them exactly where to enter a trade, and then they get frustrated when it doesn't work. But the truth is, Fibonacci is not a standalone tool. It works when you combine it with trend, structure, and price action. That's it. So today, I'm going to break down a simple framework that takes all the guesswork out of Fibonacci trading. We're going to cover how to set up the tool so it's clean and actually usable, how to identify the right levels to pay attention to, and most importantly, how to wait for confirmation before you enter a trade. And just so you know, I'm not going to sit here and tell you this works 100% of the time, because it doesn't. No trading strategy does. But what I can tell you is that when you follow this process, you're putting yourself in a position to take high probability trades with favorable risk to reward ratios. And that's how you become consistently profitable over time. So if that sounds good, go ahead and smash that like button for me. Hit subscribe if you're new, and make sure you click the notification bell so you don't miss any of our content. So let's get into it.
Alright, so the first thing we need to do is set up the Fibonacci tool the right way, because if you're using the default settings, you're making this way harder than it needs to be. Let me show you what I mean. This right here is what the Fibonacci tool looks like when you first add it to your chart. You've got all these lines, all these numbers, background colors, price labels. It's cluttered, it's confusing, and honestly, it's useless. Now compare that to this. Clean lines, clear values, easy to read, and you can actually see what matters. This is what your Fibonacci tool should look like, and I'm going to show you exactly how to set it up step by step. So first, you need to access the tool. On most platforms, you're going to find it under your drawing tools or Fibonacci tools. On TradingView, for example, you come to the toolbar on the left, find Gann and Fibonacci tools, and select Fibonacci retracement. You can also click this star icon to add it to your favorite tools. Once you've got it selected, you click once on your chart, drag it up or down depending on your trend, and click again to lock it in. Because the default settings are garbage, we are going to fix that. Click on your Fibonacci area, and you should see a settings icon pop up. Click that, and your settings menu will open. Now we're going to go through this step by step, and I want you to follow along if you're at your computer right now. Step 1. Remove the Fibonacci levels that go past 1. You don't need 1.618, 2.618, any of that. We're focused on retracements, not extensions, so go ahead and uncheck those levels. They'll disappear from your chart. For the setting I use, I also remove the 0.236 and 0.786 fib levels. Step 2. Remove the background color. It's distracting and it doesn't add any value. Just scroll down and uncheck the background option. Step 3. Remove the price labels. You don't need to see the exact price at each level cluttering up your chart. Uncheck the price label option. Step 4. Move your Fibonacci levels to the right side of the tool. This keeps everything organized and easy to read. In your label settings, click this drop down here and change it from left to right. Step 5. Make the font bigger. You want to be able to see these levels from across the room if you need to. Click the font size setting and bump it up to at least 16 or 20. Step 6. Make the lines thicker. Thin lines are hard to see, especially if you're looking at multiple time frames. Scroll up to where it says Levels line and choose the thickest option available. Step 7. Remove trend line by unticking the trend line button. Step 8. Color code your levels based on importance. This is huge. Not all Fibonacci levels are created equal, so we're going to use color to show that. Change your 0 and 1 levels to white. These are reference points, but they're not where we're looking to enter trades. Leave your 0.382 level to orange. This represents a shallow pullback. And finally, change your 0.5 and 0.618 levels to red. These are your highest probability zones. Red is a visual reminder that these are the levels that matter most. And that's it. You now have a clean, professional-looking Fibonacci tool that highlights the levels that actually matter. This setup alone is going to save you time and reduce confusion every single time you open a chart. Now, if you want to access TradingView, I'll drop a link in the description below. It's completely free to use, and it's what I use for all my analysis. All right, so now that we have the tool set up, let's talk about how to actually use it.
Question everyone asks: which Fibonacci levels do I actually pay attention to? And the answer is simple. In an uptrend, you're looking at 3 levels: 0.5 fib level, the zone between 0.5 and 0.618, and 0.618 itself. In a downtrend, the same thing: 0.5 level, the zone between 0.5 and 0.618 Fibonacci level, and the 0.618 level. Let me break that down for you. The 0.5 Fibonacci level represents a deep pullback within a moving trend. It's good. It's not perfect, but it's good. If price pulls back to the 0.5 level and you get confirmation, that's a solid trade setup. The zone between 0.5 and 0.618, that's great. This is where you start to see really high quality setups because you're getting a deep retracement, but price is still respecting the overall trend. And then you have the 0.618 level, which is the best. This is what we call the golden ratio, and it represents a very deep pullback within a trend. When price retraces to the 0.618 Fibonacci level and holds, you're getting one of the highest probability setups available. Now, you might be thinking, what about the 0.382 level? And look, some traders use those levels and that's fine. But for me, 0.382 level represents a shallow pullback. It's not deep enough for me to consider it a high probability area of value. I don't trade the level, but if they work for your strategy, keep it. The key here is understanding that Fibonacci levels act as support and resistance within a trend. They represent areas where big money, institutional traders, smart money, whatever you want to call them, they're looking to add to their positions. And when they do, that creates momentum in the direction of the trend, which is what you want to be trading with. So in an uptrend, you're waiting for the price to pull back to one of these levels, and then you're looking for confirmation before you go long. In a downtrend, you're waiting for the price to retrace up to one of these levels, and then you're looking for confirmation before you go short. And that word confirmation is very important, because here's what most beginners do wrong. They see price hit a Fibonacci level, and they immediately enter a trade. No confirmation, no price action, no structure, nothing. They just click buy or sell because the Fibonacci level is there. And sometimes that works, but most of the time, you get stopped out because Fibonacci alone is not enough. You need confluence, you need price action, you need structure, and that's what we're going to talk about next. I'm going to show you how to place the Fibonacci tool on a chart, how to identify which levels matter, and how to wait for confirmation before taking a trade. We're going to start with an uptrend example, and then we'll look at a downtrend. So here on the chart, you can see we have a clear uptrend. How do I know it's an uptrend? Because we have higher highs and higher lows. This is basic trend identification, but it's important. If you don't know what the trend is, you have no business placing a Fibonacci tool on the chart. You can check some of our videos on that later. So we've got our uptrend. Price makes a move up. This is what I call an impulse move. Then price pulls back. This is the corrective move. And this pullback is where we're going to apply our Fibonacci tool. Here's how you do it. Click on your Fibonacci tool, and you're going to click once at the most recent swing low. That's where the impulse move started. Then you drag your mouse up to the most recent swing high, and you click again to lock it in. Extend the tool a little bit to the right so it stretches out past the current price action. This gives you room to see where price is headed as it retraces. And there you go. Your Fibonacci levels are now plotted on the chart. You can see the 0.5 fib level, the 0.618 fib level, and the zone in between. So now the question is, what do we do? Do we just wait for the price to hit one of these levels and enter a trade? No, absolutely not. You wait for confirmation. What does confirmation look like? It looks like candlestick price action showing that price is reacting to the Fibonacci level. It looks like long wicks at the level. It looks like a trend change confirmation, like a bullish momentum candle, a candle color change, or a reversal pattern like a double bottom. Let me show you an example. Price pulls back here to the 0.618 fib level. This is a very deep pullback, which is great. And look what happens. Notice how the candle that touched 0.618 fib level is smaller in size. That's the market telling you, hey, there are buyers here. This level is holding. Then you wait for your trend change confirmation. In this case,
You get a bullish momentum candle that's also a candle color change from red to white. That's your confirmation. That's your entry signal. You go long right there. Set your stop loss below the 0.618 fib level and target the next structure high or beyond.
Now let's look at a downtrend example, because it's the exact same process, just in reverse. Here we have a downtrend. Lower highs, lower lows. Clear as day. Price makes an impulse move down, then pulls back up. This pullback is where we apply the Fibonacci tool. Click once at the most recent swing high, that's where the impulse move started in a downtrend. Drag down to the most recent swing low, extend it to the right, and click to lock it in. Now your Fibonacci levels are on the chart. Price starts to retrace up, and we're watching the 0.5 fib level and the 0.618 level. Price comes up and hits the 0.618 fib level. You see candles with wicks sticking out, showing that sellers are stepping in at this level. Then you wait for confirmation. You get a bearish momentum candle. That's your confirmation. You go short, set your stop above the 0.618 fib level, and target the next structure low or beyond. This is the process. Identify the trend, apply the tool from swing low to swing high in an uptrend, or swing high to swing low in a downtrend. Wait for the price to retrace to a key Fibonacci level. Look for price action and confirmation, then enter the trade. It's simple, but it's not easy because it requires patience. You can't just force trades. You have to wait for the setup to come to you. Note that not every pullback is going to hit a Fibonacci level. Sometimes the price doesn't pull back deep enough. Sometimes it blows right through your levels. That's fine. You don't trade every move. You trade the high probability setups and you let the rest go. Now, if you really want to take your Fibonacci trading to the next level, you need to combine it with support and resistance. Because when a Fibonacci level lines up with a key support or resistance level, that's when you get the highest quality setups. Let me show you what I mean. Here on the chart, we've got an uptrend. Price pulls back and we apply our Fibonacci tool. The 0.5 fib level is sitting right here. But look at this. We also have a support level from previous price action that lines up almost perfectly with that 0.5 Fibonacci level. This is what we call confluence. You've got two reasons to believe price will hold at this level: the Fibonacci retracement and the structural support. When price pulls back into this area, you're not just relying on Fibonacci. You're relying on a zone that the market has respected multiple times in the past. So price comes down, hits this confluence zone, and you start looking for your confirmation. You see candles with long wicks, showing rejection of lower prices. Then you get a bullish momentum candle, or a candle color change. That's your entry. You go long, and because you have confluence, your probability of success is higher, and your potential profit is greater. Same thing in a downtrend. You've got price retracing up to the 0.5 or 0.618 Fibonacci level, and it also lines up with a key resistance level, an old support level that's now acting as resistance. When you have that confluence, you have a much stronger trade setup. I'm going to show you a few more examples of this because this is where Fibonacci really shines. Here's another one. Downtrend. Price retraces up. The 0.5 Fibonacci level lines up with a resistance level. Price hits the zone, you get wicks sticking out, you get a bearish candle, and boom, price drops. Do you see the pattern here? It's not just about slapping Fibonacci on a chart and hoping for the best. It's about waiting for the setup to align with other factors: trend, structure, support, resistance, and price action. When all of those things line up, you have a high probability trade. When they don't, you wait. All right, so before we wrap this up, I want to cover some of the most common mistakes I see beginners make with Fibonacci. Because if you can avoid these, you're going to save yourself a lot of time and a lot of money. Mistake number 1, placing Fibonacci on every single move. You don't need to do this. Not every move is a high-quality setup. You're looking for clear impulse moves with clean corrective pullbacks. If the trend isn't obvious, don't force it. Mistake number 2, entering trades at Fibonacci levels without confirmation. Fibonacci alone is not enough. You need price action. You need confirmation. Wait for the candles to show you that the level is holding before you enter. Mistake number 3, Ignoring the overall trend. Fibonacci is a tool for trading with the trend, not against it. If you're in a downtrend and price pulls back to a Fibonacci level, you're looking for short setups, not long setups. Don't fight the trend. Mistake number 4, using too many levels. Keep it simple. Focus on 0.5, 0.618, and the zone in between. If you clutter your chart with every Fibonacci level under the sun, you're going to confuse yourself and miss the high-quality setups. And mistake number 5, expecting Fibonacci to work every time. It won't. No tool works 100% of the time. There will be trades that don't work out. There will be times when price blows through your levels. That's part of trading. What matters is that over time, when you follow this process, you're putting yourself in a position to take more winning trades than losing trades, and you're managing your risk properly. So here's my final advice. Master the basics first. Learn how to set up the tool correctly. Learn how to identify trend and structure. Learn how to wait for confirmation. Once you have those fundamentals down, then you can start adding layers like support and resistance, moving averages, and multiple time frame analysis. And speaking of multiple time frame analysis, that's something I'm going to cover in a future video. So make sure you're subscribed with notifications on so you don't miss it. Alright, so that's Fibonacci retracement trading for beginners. If you found this video helpful, go ahead and smash that like button. If you're new here, hit subscribe and click the notification bell so you know exactly when I drop new content. And if you want to take your trading to the next level, I've got a free trading community linked in the description below. We share everything from price action to risk management to building a complete trading plan. It's totally free, no catch, just click the link and you'll get access. If you're serious about becoming a consistently profitable trader, check it out. Link is in the description. Drop a comment below and let me know. Have you used Fibonacci before? What's been your biggest struggle with it? I read every comment and I'll do my best to answer your questions. Thanks for watching, and I'll see you in the next one.